Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, August 4th, 5:05 p.m. Eastern Time, coming to you from St. Augustine, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend. You can see over here by the trend gauge. Yesterday, we updated leaders from neutral to bullish, joining our short-term trend and our medium-term trend as uptrend or bullish. Basically what this means is that all 5 of the major indexes that we cover in these videos are trending above their uptrending short-term 21-day exponential moving average and above their medium-term 50-day moving average. Market leadership, primarily the 21 over 21 list and the G6 acting fine. So they're in bullish / uptrend. However, long-term, we continue to trudge higher, but we are still below the declining 200-day moving average. As I say a lot, this is where risk is highest when we're in the market, so we're always keeping an eye on what's going on. But so far, a 10% plus rally off of the lows. We'll get, if this continues, we'll get to where the rubber will meet the road up at the 200-day moving average, or if the current breakout from this bull flag, the short consolidation that we had yesterday, if that fails, that might put a pause in the rally, and we'll check out the charts momentarily and you'll see what I'm talking about. So what just happened today? Healthy chop, tight range, leaves the breakout intact. G6, our in-house composite of 6 growth ETFs, slightly down on the day, along with the sp500. NASDAQ 100 led up 0.5%, Dow down 0.25%, midcaps down 0.73%, Russell down 0.1%, 60/40 global diversified stock and bond index up 0.24%. Our flagship portfolio, GROTECTION, up approximately 0.25%. Let's get to the tail of the tape and the index review, and then some chart review. First, let me explain what we do here at Revere by using a chart of the sp500. Basically, I mentioned the 3 time frames. The long-term time frames is black line. That's the 200-day moving average. The red line is the intermediate term 50-day moving average. The green line is the short-term 21-day exponential moving average. The purple line varies. Sometimes I have it as an 8 EMA. Sometimes I have it as a 100 EMA. Right now, because the 100 was most critical to what's going on with the indexes, I've got it as a 100 simple moving average, where we took a natural pause off the bottom there before breaking out of this little flag, this 3-day flag yesterday. So if you'll notice over here, going back to November, December, all of the moving averages were stacked the way we wanted them to be. That is, the 21 was above the 50, which was above the 200. When the market's like this, we're participating in the uptrend, especially a situation like this where we're really trending higher. Now we start to take a pause here. We'll get below the 100-day, coming down into the 50. This is where we would go neutral short term, and then to bearish short term as it rolls over. 50-day bouncing around there, so that would be neutral, but we'd still be above the 200-day moving average. So we'd get to starting to consolidate across multiple time frames. This is when we would pull back a little bit in the market, break out, we'll participate again, but now we start rolling over in the beginning of January, and this is where we understood that the short term, then the medium term, then the long term trend turned down. This especially was confirmed in April, and that's when we just get the heck out of the way, protect our capital, and wait for the market to improve, as it has over the last couple of weeks, off the bottom, back above the short-term 21-day, back above the intermediate term 50-day. They start turning up, the market starts going higher, and next we're coming into this downturning 200-day moving average. So that's how we trend follow across 3 time frames. That dictates how much exposure we have to the market, and whether or not leading stocks and leading sectors are of the growth variety, which they have been more lately. Prior uptrends were led by staples, utilities, and defensive type stocks. That's not going to be a way to make profits in the market. That's just a way for fund managers to park cash while they wait for better days. and better days are kind of what we've been seeing over the last 3 weeks as we've increased our participation. So that's how we trend follow at Revere Asset Management. If you're interested in becoming a client or want more information, reach out to me. Email don@revereasset.com or phone 855-REAL-WEALTH. That's 855-732-5932. So here's your S&P 500. Here's that bull flag that we broke out of. Let's take a look at a 15-minute chart here. So here was the final day up, and then we went sideways, keeping in mind the range that we had on the final day where we were higher. So chopped inside that range, chopped inside it again, a little bit lower. So that's a bull flag. You start making lower highs and lower lows while maintaining the bullishness of the prior uptrend. So we haven't violated anything. We didn't violate the lower day of the last day up. And then on Wednesday, we had a little gap up and we trended higher, broke above this 41.45, 41.40 level. So that's a breakout of the bull flag. And we held it today. Our pullback low was 41.35. So we pierced it, but we ended up being above it. As long as we don't break the lows of any of the days in this bull flag, ideally we hold, around 41.30, 41.20, 41.30. That's the level that I'm watching. This is today's tight range is a healthy pullback, and this breakout still intact. And we added a little bit more exposure today, and we were green on the day while the indexes were green. That was primarily because one of our holdings, which we'll detail momentarily. So there's the S&P 500. Let's take a look at the NASDAQ 100, see how this is doing. Come on now. Okay, you can see the breakout was clearer and more powerful on the NASDAQ 100 on Wednesday, and we made a higher high on Thursday. So very good action here on the NASDAQ 100. This is the leading index right now. Let's take a look at the Dow Jones Industrial Average. Lagging, which is typical. Usually you either have the NASDAQ 100 leading and the Dow lagging, or you've got vice versa. Right now you've got this is what we have. We've got the Dow lagging, which nothing wrong with that. The Dow leads when we pull back. If I showed the relative strength of the NASDAQ 100 during this period of time when we were pulling back, its relative strength would be going lower because the NASDAQ 100 leads higher and leads lower, and that's because the tech type stocks that are heavy in there just move faster to the upside and to the downside. So still in a bull flag on the Dow Jones Industrial Average here, but the S&P and the NASDAQ did break out. That's what we're more concerned with. Let's go to mid caps, which have been lagging a little bit lately. You can see they're still in their bull flag. It's 5 days now, coiling. We're going to run here. As I said yesterday, markets do one of three things. They either trend up, trend down, or consolidate. Right now, we've got an intermediate and a short-term trend higher, and we're consolidating off of that. Breakouts from consolidation should be in direction of the primary trend. So if we break down, that would be a change in character. If we break out in keeping with what we did on the S&P and the NASDAQ 100, every bull will be smiling. IWN, here's the small caps. They did break out along with the NASDAQ 100 and the S&P, and they're trending higher and showing not really relative strength, but not relative weakness, kind of moving in line with what's going on with the S&P 500. That's what this relative strength line here tells me. So when it's flat and the S&P is going higher, that means it's performing about as well as the S&P 500. So that's an overview of the indexes. Let's bring up the tail of the tape now. Overlay that with the S&P 500 so we can see the key levels that we've got here and talk about what we did today. Put call ratio, neutral, dropping lately. Usually have been hanging around a 1, down to 0.86 now. VIX dropping also 21. Fear and greed ticking up. It's in neutral territory now at a 47, still operating under the bull case. Some news today, Blackcoin and Coinbase, Blackstone, or was it BlackRock? It's BLK. BlackRock did a partnership so they could buy Bitcoin for their clients, and they're going to use the coin exchange to do that. So coin was up as much as 25-30%, dropped only up about 10%. Notes tomorrow, big jobs report. We got to keep an eye on how the markets react to that. Expectation coming into today, I wanted to see any pullback of the uptrend be contained within this bull flag. So the bull flag breakout holds on any pullback. That happened with the low of 41.35, closed at 41.52. So keeping that breakout intact. Support 41.20, 41.30 area, which is in the bull flag, that held. Didn't test resistance. NASDAQ 100, this is this big fib, and it's also in the 100-day moving average and in the bull flag area. Big, so it's a very big area for the NASDAQ 100. Neither it nor overhead resistance at 330 was tested today. Action today, gap down not even a gap down, down 0.05%, tight range, tightest range we've had in a while, 0.63%. For comparison, the S&P 500 ATR has dropped from 2.79 all the way down to 1.75 over the last 6 weeks. The volatility contraction is actually good for bulls. It's when you see these huge spikes up and down that the ATR on the S&P gets inflated. This is still above historical norms at 1.75, but like I said, it has come down quite a bit. So today's range 0.63%, only a third of what the ATR currently is, which means when I recalc this tomorrow, I would expect it to be lower. So sectors that continue to act well today, biotech. This really, when I got stopped out on one close below the 21 a couple days ago, really making a fool out of me. They say things wear you out or scare you out. This kind of just wore me out, and then the close below the 21 was the final nail in the coffin, and now 3 days up off of the 100-day moving average. This has been the fire was lit by several stocks participating, but the big one, ALNY, which made a day 2 higher high today. In fact, a gap down and then moved higher outside bullish reversal. Big volume again, 263%. This was on a phase 3 drug positive results. The target audience for this, the target market, not huge from what I've read, but price overrides my opinion on that. We don't own it, but we're certainly watching it. ALNY. And now let me segue to after hours net, former darling of hedge funds, with a big drop all the way down from, let's look at the weekly chart on this. You'll see how bad this actually dropped down. This thing peaked at 222 all the way down to 38. Kind of amazing, but some leaders will return, and after hours net is up 22% on their earnings report. You can see it trying to put in this bottoming base. This is going to be it's right at this 100-day moving average. You've also got a gap fill here at 77. So let's see what happens when we get up around this area. This will provide some resistance, 76 to 80. But there's been quite a bit of volume after hours on net too. So we closed at 5.5 million. Net is now at 6.7 million. So over 1.2 million shares have traded after hours. That's a lot. It's not a phenomenal number, but this is a big number, being up 22% after hours. So little tangent there, but those are the two stocks that I wanted to highlight today. What else acted well? ITB, because interest rates dropped under 5% nationwide on 30-year mortgages. ITB, everybody's saying, no, you cannot, the builders cannot go higher. Well, they've been trending higher here, taking a little bit of a break as they go sideways after relative outperformance, holding the 21-day on this pullback. DHI, one of the better charts, looks a lot like the ITB chart under the 200-day moving average. Again, relative weakness as it's consolidating after a period of uptrending relative strength over 4 weeks here, and now 4 weeks lagging while price goes sideways. But ITB had a good day today on the interest rate news. GLD and GDX continue Another one that wore me out under 160 here into the 50-day moving average on gold and GDX, trying to get above some key resistance here at the 21, closed right above it. And this coincides with weakness in the US dollar. Since while the dollar was strong, gold couldn't go anywhere. Even when it started to pull back, gold wasn't going anywhere, but it did start going after about the last week and a half. But you can see UUP got above the 21 yesterday, back below it today. Stocks really didn't respond to this move down. Normally, a down day like this on the US dollar would be positive for stocks, but we did just have this bull flag breakout. So some natural rest here, not necessarily going in lockstep opposite of what the dollar is doing. Solar's continued to act well today. On the downside, I mentioned the dollar. Oils continue to get taken apart, and cybersecurity, Fortinet, one of the leaders, was actually on the 21 over 21 list. Not anymore, not after a 16% down day on 300% above average volume, completely breaking down on its earnings report, and it also hit the entire sector. Here's the CIBR, which broke out but failed to break out, and back kind of into this prior base area, broke out above 44. Not a bad close on the candle, but we're going to have to see, down 1.55%, we're going to have to see an emerging leader in cybersecurity. Some of the ones that I saw aren't liquid enough for us, but it's a big, obviously cybersecurity isn't going away, so somebody's going to have to emerge to carry the torch for the group, and we'll be keeping an eye on whoever that is. So what do we do in-house today? LNTH reported earnings and had a gap up pre-market, but not a lot of volume. When you see a gap up with not a lot of volume, you got to be on guard, and it had a really brutal shakeout early in the day. Let's take a look at this 50-minute chart. There's your gap up. Immediately, a massive seller hit here in this 15-minute candle. It dropped 11%. Then it started to come back. When it came back and got back above the 21 and was looking stronger, this is where we took a 2% size position in there, thinking we got all of the sellers out. Late in the day, it faded though, but we're still sitting just a hair below the 21-day moving average. Again, 2% size. If we go below the 21 by 2% tomorrow, we're going to be out of this and looking to redeploy that money into better spaces. But right now, this is an algo-driven gap up. Got rid of all the buyers, or sucked in all the buyers up here at the top. Get rid of all the sellers down here under the 50-day moving average. You can see people that trade the 50-day moving average, it poked beneath there. Got rid of all those stops. Never set your stops right below a key moving average. You got to give it a little bit of room, or the algos will come and get them. And that's what happened today. That's what this chart is telling me. Now, flattening out of the 21-day. Let's see where this goes tomorrow. They did up guidance and report phenomenal numbers: 700% earnings growth, 121% sales growth. 2 consecutive quarters of 120+% sales growth. You can see the numbers over here. PE is reasonable at 35, even with deceleration into 2023. Still going to be up 19%. Those numbers are fundamental numbers. Price and volume overrule those. You buy on fundamentals and technicals, but we sell on technicals only. If it breaks down, we'll be out of it. Let's talk about the stock that carried our portfolio today. Silvergate got an upgrade, probably spiked a little bit by that Coinbase news, as they are a crypto network. But you can see here the massive volume these 3 days as it came off the volume, consolidated on lower volume, above average volume the last 2 days as it's broken above this little shelf here around the 95, 96 area, and a higher high today. Like I said, above average volume up 7.2%. This is what primarily led us to a positive day today. This in end phase. I talked in yesterday's video about how we snuck in here with a small 2% size until this tightens up and pulls back into some moving averages, but love the way it's participating and holding near these highs. This is very clearly the leader. One of the things we always try to do is have what's our Fab Five. This is on them, and you got to try to find a way into your Fab Five that is at as low risk an entry as possible. And sometimes you just have to go down to lower time frames in order to find that. Let's take a look at a 15-minute chart on N phase here. So you can see here it's consolidating. It was consolidating yesterday, and it got back down and tested this 275 to 280 area and then got tight. This is where we got in with our first buy and then our second buy. And as long as we hang up here, we're going to be okay. If it breaks below this consolidation within the bigger move up, now granted, we're extended above the 21. I talk about the 21 a lot, but when you have these big monster gaps up, these rules kind of get thrown out the window, because this is just screaming that institutions are buying with the big volume on the 2 days after the earnings report, and then continued higher volume over the last couple of days. Today's the first day of below average volume since that big earnings move up. And this is a textbook picture of what happens with big winning stocks. There's no guarantee, but a lot of them start out this way. Look back to July 2013 on Facebook to see a very similar picture. Huge volume, big price move up, and then it continues higher. If Arizona Senator Kyrsten Sinema throws cold water on the reconciliation bill, this could pull back hard. If it does, we'll get stopped very quickly. But right now we've got some gains in it, and those were the two primary stocks that drove the portfolio today. I'll also show the other two biggest holdings that we have. ON Semi, nice below average volume consolidation day. This buy on LNTH was very similar to the buy that we did on ON, which was a gap down on earnings from a strong stock, and then you get the sellers out, and then the buyers show up the next couple of days. This is what's happening so far on ON. It continues to be a leader. If that same situation takes place on LNTH, we'll be really happy. If it doesn't, we'll be out with a small loss. And our other biggest position is T-Mobile, and that just continues to trickle higher after its breakout. Granted, volume is really drying up, but still intrigued by these big 2023 growth numbers with a 28 PE on T-Mobile. So for now, we're firmly in the green on that also, and that is going to wrap it. So you got your Fab Five. We'll talk later in the week about the Fab Five that we're putting together in the shop here, and trying to get some money into them at low risk entries. And that's going to wrap it. So as always, love to hear your feedback. Don at RevereAsset.com. 855-REAL-WEALTH is the phone. That's 855-732-5932. If you want to join a registered investment advisor that trend follows, that means we've got your downside protected, and we participate in the upside as we demonstrate in these videos every night. We'd love to hear from you. So, wrapping up Thursday, April 4th, this is Don Vandenbord telling it like it is, just the facts here at Revere. Thanks for listening, and have a great day.